welcome to the closing beat, everybody. Happy Thursday to you. Hope you're having a good day out there, getting ready for the Super Bowl. Any fancy Super Bowl bets out there you guys want to tell me about? All those funky little bets you can make. We were just talking about that. How many times are going to say Taylor Swift and the people recording the national anthem, you know, doing their thing. But we're financial advisors, so we focus on the dollars here. Happy to help you guys, and thank you for watching. While other advisors are playing checkers, we are playing chess. Remember that if you live in a disaster-related area, that your tax filing wasn't due until the middle of February. Well, it's almost the middle of February, so a couple reminders I've had to tell people that have decided to wait till the last second to file their tax return. And also remember, it doesn't mean you got to wait to pay if you owed. If you underpaid, there's an issue there. But for the filing there, you have just a few more days to get going. We'll talk about that more tonight. And then also on our Wine and Wealth here tonight, we're going to talk about a few 401k tricks that I bet you didn't know. I've never done a video on them. I've never talked about them. But some of the little fine print stuff that you're like, oh, if that applies to me, then I want to take advantage of it. So we'll cover all of that. And then last week we did the February financial focus, things to really just a couple things to work on for the month of February. Each month, cover a couple things. Make sure you get your dough straight by the end of the year. We're going to keep doing it. Let's talk about the stock market here. Here's the S&P on the screen. We're looking at the S&P futures, actually, hitting almost new highs. We're right there, right? Officially, the index hasn't quite hit 5,000 yet. We're less than 3 points away. I'm sorry, no, we're doing it, right? We just haven't closed there. So working on that one there. Broadly today was kind of a snoozer. Yeah, there were some good areas. The Russell 2000 was one area that did well, but inside the S&P, a little bit tricky there, and we're going to cover a little bit more of why that is here in just a minute. You've got the Dow. There you go. That's 11 record closes. I'm looking at the Dow futures, of course, so that's changed ever so slightly. But the index itself has had 11 record closes this year already, and obviously moving in the right direction there. If you look at the NASDAQ, we're less than 2% away from hitting a record. Besides the Russell, that one's got a little bit more to go. 1.6% or something like that. Really, really close. And with the help of some of the tech stocks that we've seen, of course, that looks like it's going to continue. Gold not doing a whole lot there, not much to mention. Bonds continuing to see interest rates rise, prices drop, interest rates rise. That's how that works. And largely in part because it has become very clear, Fed speak, right? All the Fed members out there talking. It's become very clear that they're hinting at May as the earliest possible time to cut rates, if they do, right? They haven't committed to that. So you now have less than a 20% chance of a March rate cut, which that's basically off the table at this point, unless something magical happens. And by magical, I mean disaster in March. But there's a 60% chance now that on or before May would be the first rate cut there. If things keep going the way they are, I would suspect that the language would change a little bit and start trying to push it out a little further. What's the rush? Ask yourself that. Why does the economy need lower rates? It's all going swim. You can make the credit card delinquency argument. I saw that the other day. I'm like, okay, but that could be part of it. You can't use mortgage delinquencies. You can't use mortgage sales. You can't use new or existing home sales. You can't use inflation. Yeah, it's come down, but okay, it's down, right? If we cut too soon, that's their worry is that, oh my God, we see this rebound in inflation. We'll see. We'll be talking, of course, a whole lot about that. Elsewhere, I do want to point out energy was your leader here today, thanks to a strong move in oil. Not really finding this all that interesting. It's kind of jello on a plate, as I usually say. Yes, we're trending higher, but in a really sloppy way. There's no commitment either way. And why is that? Because there's a lot of, if you ever look at our agreement, so if you join us at Jazz, or if you have joined us here, there's a whole agreement, just a nonsense of stuff we have to put in there. And legally, it has to be written in plain English. So you can't say, whereas thenceforth this happens, we will, take action, whatever. So there's a section in there that defines the different types of risks that we will take. And at times, one of those is called geopolitical risk, which is just a fancy way of saying, hey, the price of something that we choose to invest in could move purely because of geopolitical risk. Wars, political events, assassinations, really crazy things that could maneuver, or the Red Sea, what we're dealing with there, could have an impact on some of our investments. And so right now you would say the risk in oil is geopolitical. right? It has nothing to do with supply and demand. In fact, the supply side of it would tell you otherwise, that the price of oil should be higher. So with all that in mind, that's just a long way of saying I'm not really excited here, but today obviously people were excited about energy. And if you own any energy stocks or funds or in your 401k or whatever, you're likely going to find that was the better performer. All right, we're going to bounce around here just a little bit. All right, Disney. Who doesn't love to talk about Disney, right? So Disney, they come out with their earnings here. There was a lot to digest in what happened there. There's the headline stuff. There's the underlying stuff. Let's just break it down in layman's terms. Disney says, you know what? We had a record quarter. Our sales were up almost 25% more than expected there in the parks. They call it the experiences, right? The parks, the cruises. You could look at sports, right? All great. Yes, people in the park spending all their money. The cruise ships are just booked solid. Everything's good. The weakness, if you're going to look for weakness there, was in entertainment. However, the weakness in entertainment is not anything new. So I took a second to kind of break this out for you so you can understand, if you were a little bit curious why Disney did so well. Let's take a look. So here is their Disney Plus subscriber growth rate, right? And what we've done is, since day one, we've just kind of plotted it out in millions so you could kind of see. The growth rate of Disney Plus has more than slowed, right? Since like October of, well, that would be October 2022 at this point, right? So we know that. That has been reflected in the price. If you look at the price of the stock, of course, they've been beaten down as the Disney Plus excitement, whatever, has worn off, and all who is going to sign up for it likely has signed up for it, right? So I shouldn't say it that way, but basically the growth projections have slowed down. These are actual numbers. So the issue here is entertainment was the area that caused any kind of weakness that you would see. Hulu Plus, Disney Plus, Live TV, what's the other plus? ESPN Plus, right? All saw weaker subscribers there and missed, and more importantly, I should say, had losses that were quite large rather than what we were expecting, losses of about 45% more than expected. So you say, okay, well, that's the bad news there. We know, though, of all of this. So you ever see that? Sometimes bad news is good news. Well, that's because the bad news was not as bad as expected, right? You know what I mean? It's kind of a weird thing to say, but that's how it is. Then they threw in all this other stuff. They say, oh, let's just raise our dividend. Technically by 50%, right? So yeah, that's nice there for people investing in Disney. Then they did the magic thing. What's the magic thing? We've been covering it all week. Share buybacks. They're going to buy back $3 billion worth of shares with no concern at all about the 1% tax. And if you saw yesterday's show, you know why. They could care less. It's not going to hurt them. So anyways, you got $3 billion in buybacks, and we know that at this point in life, in the economy, the stock market, or investors in the stock market like to see you buying back shares. That's a long way of going over what happened with Disney. Now, Disney is a great segue into my next comment here, because we now have, this is a very early warning. This is not like, oh my God, look at this, this is crazy. No, very early warning here. More and more industries are starting to get overbought. This can be a really tricky and technical thing to talk about, so I'm going to try to break it down in a simple and kind of visual way here. Remember that when we look at the S&P, that is the index. That's the big bucket. And then we dive into that bucket and we go, I don't really care what parts of the index are doing. I want to look and zoom in. There are 11 different avenues you can go down. They call them sectors. So energy, communication services, consumer discretionary, et cetera, blah, 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 right? So we see the performance of the big beast, and then we go inside of it and say, oh, well, how is each little sector doing? Well, inside those sectors, there are industries. That's it. We won't go any further. There are sub-industries, but often people don't look at that. So index, sector, industries. There you go. That's the whole S&P, just broken down into pieces there. Keep in mind it's a market cap weighted index, so some stocks themselves can really move things along. So anyways, the point of that is, more and more industries are becoming overbought on the traditional, basic technical analysis everybody uses. This is not my opinion. This is just every analyst is talking about this right now, especially JP Morgan, Goldman Sachs, etc. So let's take a look. We have basically plotted the industries, right? So you can see them. And what we're doing is we're referencing the averages stocks distance from the 50-day moving average. Okay, really simple to understand that part. And then we're, on the y-axis, we're saying the group or the share of the stocks that are that are more than 2 standard deviations away from their 50-day moving average. Okay, that's considered overbought. We got a problem here. So not only are we saying as an industry we're overbought, but then we're saying, hey, inside that industry, tell me the share of stocks that are actually overbought from their 50-day moving average. With me? Hopefully I didn't butcher that. Let's give you an example, because I just said Disney a second ago. Disney falls in the media and entertainment area of the market. This is a really zoomed in way to go, hey, I want to maybe take some profits and put them elsewhere. What do I do? How do I just analyze this without looking through a billion stocks, right? So Disney's in media and entertainment industry. It's a consumer discretionary, it's communication services, and it's in the S&P 500. See? We've come down to media and entertainment. So Disney, as an example, falls into an industry whose average stock is not so far away from the 50-day. Disney would be one that is, but that the number of stocks that are way away from their 50-day moving average is quite a lot. And you can see that there are more industries trending overbought than anything else. So for example, Disney, I'll go back over here. I'm getting to it. Don't worry. So you don't have to trust me on this one, right? Blue line is a 50-day moving average. We are way above it relative to its history. Okay. It's okay. That doesn't mean it's a bad stock or anything. It's 19% above its 50-day moving average. It is 5 standard deviations away from its 50-day. Why do we talk about that? Now we have something to measure, right? So whether you believe in all this or not, now we have metrics to say, is that odd? That's the number one question I ask when I look at our portfolios and all the positions we make. The fact that that happened, is that odd? Disney going up 19%. Disney being about 5 standard deviations away from its 50-day moving average. Does it do that often? I don't think so. Now we can take that metric and look back through the life of Disney and find out, oh, that doesn't normally happen. Okay, great. What does that tell us? It doesn't tell us it's a bad stock. It tells us, if we were looking to buy it, now's probably not the best time, right? Love the excitement, love everything they're doing, their whole focus on profitability, the share buybacks, blah, blah, blah. But am I a buyer today? It's a quick way to go, if I'm a buyer today, I better be willing to either wait for better performance, or I'd better be willing to sit through a little bit of a pullback. I am not willing to do either of those because they say time is money, right? I don't want to buy a stock and then sit around and wait to make money. So really, really cool when you look at that. Now, going back real quick, I know I'm all over the place. Okay, so do you see semiconductors on the list? What's happening? The average stock is quite far from its 50-day moving average. It's just a real visual way of saying something great has happened there. It's AI, by the way. So something great has happened there. The average stock is also quite far from its 50-day moving average as a whole. The industry is not so bad, but you're looking at that going, I don't know if I want to be participating there. Let's give you an example. Probably give you a couple I can think of off the top of my head here. All right. Cirrus Logic, semiconductor, right? It is 4 standard deviations away from its 50-day. It's not magic, to say that, oh, that seems like a lot. It's telling you that this is an odd move. Maybe you like the stock. Maybe you own it. If you own it, get your mind right around defense. Start thinking, well, that's a big move really quick. I might be on the hook for some time to pass where nothing happens. And if you're okay with that, you stick with the stock. Not a big deal there. I'm not going to go through a bunch of this. Okay, so let's just bounce back over here. So you can break it down. Transportation sticks out to me, and that's because we just saw their earnings come out the other day. So XPO, logistics, you've seen their trucks, Look at it. Okay, what'd we do? We started at the index and said, looks pretty good. Basically going to hit records, all is fine. We go down to the sectors and go, I don't like them all. The energy thing we talked about. Go down to an industry and you go, yeah, I don't know. I don't think I'm going to want to do much research here. We point out Old Dominion, right? Oh, yeah. Okay. Well, that's fine looking stock. Everything's good. It looks fine. Do I want to be a buyer today? That's the key to all of this. You, as a person who has money, hopefully, that you can invest, not necessarily in the stock market, but in anything. Do you want to buy the house that rapidly rose in value because BlackRock came in and bought 7 homes and sold them for a whole lot more, and you're the house that just saw a higher value there? Do you want to buy that one? Why didn't BlackRock buy that one? That's weird. They bought the other ones, but they didn't buy that one. I don't know. I think I want to think about this, right? So you do the same thing in the stock market or your mutual funds in your 401k, your IRA, brokerage account, whatever you're out there having fun doing, you take the same analysis, right? And I'll just go sales pitch in there. If you don't want to do it, you don't like doing it, know that I eat this stuff up. I love doing it. It's my favorite thing to do. jazzwealth.com. It's on the shirt every day. Happy to have you. Okay, so did that help? And hopefully that wasn't like way out of line, but I do these things where I start looking and then I go, there's probably a lesson there. Let's talk about it. All right, let's do some stocks in the news here, other stocks in the news, and then I'll take your questions, get on about our way, because we got Wine and Wealth tonight. Looking forward to that one there. I love sharing new things that people go, oh, duh, never thought about that. PayPal, big mover today, right? Down 11%. Is that odd? You can use the research site to find that out if you'd like, but no, it's not really that odd for PayPal. This sort of thing does happen, particularly around earnings, but it's a big mover there. Revenues beat by 2%. Payment volumes, you clicked it, you used it. Those beat. Earnings beat by 9%. The sad part of this story was in guidance. Ooh, did they lower guidance? You see the headline that says, they beat on earnings, revenues better than expected, and then lowered guidance. Yeah, but how much? It must have been a lot, right? Well, when you look into it, you find earnings are now projected to be 7% lower than expected. And they did a thing where they said, we're going to invest to put us in a position that gives us, how'd they say it? We're going to invest in a way that drives future profitable growth. Okay. You're a for-profit company. You have people that invest in you to be profitable and grow those profits. You weren't doing that this whole time? Well, what was happening, right? So it starts, you start to have questions like, I thought that was the game plan this whole time. So anyways, in order to do that, their free cash flow, money, emergency fund, savings in the bucket over there, treasuries, whatever they have them in, is going to be about 20% lower. That's enough to get the stock to give you a little bit of a down move. All right, Costco. Sales growth of 3.4%. These guys, man, they know what they're doing. Down 3.4% there. They did have that one-time dividend of $10. They've done that $15, I'm sorry. They've done that a couple times now. $10 was last time, $15 this time. Online sales up 20.9%. I personally, this is why I don't use my opinion here, I just use the stats. I kind of thought that would have done a little more. That was impressive. It didn't do it. So, to tell you when I'm wrong. Hershey, have you seen the price of cocoa? I think it hit a new high today, actually. I don't know. I actually don't know the futures symbol. I would love to show it to you. Shoot, I don't know. I'll find it. But anyways, price of cocoa. Not good. You guys are eating a lot of chocolate. Valentine's Day is coming up too. So it's eating into their cost there. But Hershey comes out and says, better than expected earnings. Everything is fine. Don't worry about it. Yes, cocoa is eating into our prices. We are still going to be profitable. And to prove it, we're going to raise our dividend. How about that? Eat more chocolate. ARM Holdings. I don't normally talk about this one, but I'm going to do it here today because how often do you see that? Nearly a 50% move there. From an earnings report standpoint, this is the equivalent of a reverse kitchen sink earnings report. You know, I've said that in the past, like sometimes when things are bad, Under Armour did this in the past. When things are bad, they just tell you all the bad stuff, like just throw it all in the kitchen sink. And, you know, down to the guy that was spending money on strip clubs and stuff at Under Armour, they're like, just get it all out, get it all out. Let's just get over this, right? That's a true story. Anyways, this is a reverse kitchen sink. They're like, times are good. Let's throw everything good in there. Make sure you use the word AI as much as you possibly can. But anyways, revenues $100 million more than expected. Imagine that. You're selling hot dogs, right? Normally total sales maybe on a day or a couple $100 or something like that. And then everybody kind of gets to know your hot dog stand. They're like, hey, he makes about $200 a day. That's its total sales. Selling them hot dogs on the corner. And all of a sudden one day you're like, yeah, I made $1,600 today. Okay, that's impressive. Something good is happening, right? So earnings were 16% above expected, the best analyst estimates there. Revenues 8% higher there, of course. The key here is AI, margins, and future growth. They apparently were way off in what they thought their future growth projections were going to be. And essentially what you see is just a repricing, a revaluation of that company, probably by a little bit more than it should be, but a revaluation of the company. Oh, we were operating based on you selling the $200 worth of hot dogs a day. If you're telling us that you could sell 1,600 and this is something's changed, right? Traffic, there's a new building in town. Everybody's coming by on these hot dogs. If you're telling us something has changed, you're worth more. And we need to address that. That's all that was. Don't fall for like hype and excitement and chase that and get all kinds of trapped and stuff in there. Just be careful. Other stuff that you had going on out there. Wynn reported earnings better than expected. Under Armour did report. I didn't get a chance to look at it. In the retail space, Ralph Lauren, Tapestry. By the way, Ralph Lauren is in one of those spaces that is, it's consumer durables right here. So Ralph Lauren would fall into this category if you're looking. And Ralph Lauren, by the way, 4 standard deviations away from his 50-day. So to just like a good comedian, to bring it all back home, right? Is today the day you buy it? Right now? Is that the best chance? I'm going to give you money. You tell me when the best time is to buy. No, you stop it. None of that. All right, tomorrow's Friday. We don't usually have a lot of earnings. We have some storage space REITs. That'll kind of be their day tomorrow, if that's your thing. So be sure to check that out. Cody, what do we have?
That was what you're asking about.
I'm going to go with that, yeah.
Oh, okay. Yeah. Actually, we got a fun leaderboard today. So we have Jennifer, Lisa, Peter, Tygest, and Joe. It appears that Jennifer and Joe, first and currently last on our board, are a couple. So nice little, I don't know, competition.
Joe's playing for Jennifer. Jennifer's going to win. He's not going to tell his wife. He's just going to.
Is that what you think? No, I like to think this is a household. I think they, talk about it every night at dinner.
Nope. Is it W-A for the last name?
No.
Oh, W-U?
I don't think so.
Oh, okay. Then I don't know. Yeah. Good. Okay. Yeah.
So anyway, yeah.
I was going to say, if it was W-A, Joe, I can't think of his wife's name, but that guy's, yeah, he would just take it. I'm selling him out, man.
Yeah.
Oh, I love it. And is that guy's, is Tygest?
Yeah, I think so. It's like digest, but with a T was my guess, but.
That might be the coolest name I've ever heard.
It's a cool name. It is a cool name.
Okay. Hey, if you got nothing going on later, or you're a client of Jazz Wealth, I should say it that way. If you're a client of Jazz Wealth, you want to learn some 401k tricks, I'll also update you on some other things going around Congress right now. We'll be doing that wine and wealth here tonight. Sadly, I don't have any wine. So, we'll figure something out. But I'll see you guys later. For the rest of you, thank you so much for watching. Hope you learned something today, right? All we're doing is looking at the same stuff every day in a different and more simplified way so we can make decisions faster and based on probable, like perfect pricing. As close as you can get anyways. All right, enjoy the rest of your day. Thanks, guys. See ya.